America now pays more in interest on its debt than it spends on its entire military. And that's not hyperbole. That's line item math. And if that weren't enough, the US just got downgraded again. Fitch just cut our credit rating from AAA to AA+, AA+, and Moody's has already placed us on a watch list. And that means the safest, most stable investment in the world, US Treasuries, now comes with a warning label. And if Treasuries aren't safe, nothing is. The big problem is it's not just psychological. Many of the largest institutions in the world, sovereign wealth funds, pension funds, retirement funds, central banks, they all have mandates that only allow them to hold AAA rated securities. If those mandates stick, they'll be forced to rotate out of US bonds and into something else entirely, pushing yields even higher. Higher yields means higher borrowing costs. Higher borrowing costs means more interest expenses. More interest expenses means, well, even more debt. And that's the cycle. And it's already eating itself. Jamie Dimon, the CEO of JPMorgan Chase, just put it very bluntly. He said, "You're going to see a crack in the bond market. It's going to happen." And that crack may have already started, just not here yet. In Japan, the 30-year government bond has lost nearly half of its value since 2019. That includes a 45% decline in just the past 12 months. The cause? Just a 1% rise in interest rates. That small move led to massive losses for Japan's largest insurers. Now imagine what happens when the world's largest debtor, the United States, it gets hit with a similar rate shock. We now owe over $36 trillion. Our debt to GDP ratio is hovering around 124%, and the deficit, over 6% of the GDP, more than double what economists say is sustainable. And this isn't wartime. It's not a depression. This is happening during peacetime expansion, and that should terrify you. Lynn Alden's research lays this out perfectly. Historically, deficits rise when unemployment rises. That makes sense. The government collects fewer taxes, and it spends more to support the economy. But since 2017, that link is broken. We're now running recession-sized wartime deficits during boom years. Even with unemployment near historic lows, our borrowing looks like we're in a crisis. And once investors realize that we're spending like it's 2008, even when the economy is supposedly healthy, they start to demand more yield to take on that risk. And when yields go up, the value of existing bonds go down. And that's the crack. This is why you're seeing gold prices stay high, even as real interest rates have moved positive again. Historically, when real interest rates, that is, interest rates minus inflation, go up, gold falls. But in the last year, that relationship is flipped. Investors are not moving back into bonds. They're moving into scarce assets, gold, Bitcoin, and real estate. And that tells you one thing. The smart money doesn't believe this system is sustainable. Let's take a step back. Before 2008, private debt was the main driver of growth. Businesses, consumers, homeowners, all borrowing. But after the financial crisis, it all flipped. Government debt has grown faster than private debt for 15 years. And that's not a temporary crisis response. That's a structural shift, a big one. And that means the entire economy now runs on government borrowing more and more and more money, constantly. But who's left to buy all the debt? That's another piece of the puzzle that is quietly shifting under our feet. The global buyer base, foreign countries, especially China, have been reducing their exposure to US Treasuries for years now. China once held over $1.3 trillion in US debt. Now that number is below $800 billion and falling fast. At the same time, the BRICS nations, Brazil, Russia, India, China, and South Africa, they're openly discussing alternatives to the US dollar. They're setting up their own trade systems, and they're buying record amounts of gold. Now the message is very clear. Reliance on US debt, it's no longer a given. And that creates another layer of instability. Because it's not just retail investors or hedge funds that are holding these bonds. It's the banks. Most regional banks in the US are sitting on mountains of long-dated treasuries purchased during the zero-rate era. When interest rates shot up, the value of those bonds collapsed. But instead of marking those losses and taking the hit, banks just moved them into a category called held to maturity. It's legal, but it's hiding hundreds of billions of dollars in unrealized losses. And that's exactly what took down Silicon Valley Bank. The only reason more banks haven't failed is because we're pretending that all those losses don't exist. Yet, this is also a problem in commercial real estate. Meanwhile, rising yields ripple into everything, especially housing. Mortgage rates now hovering between 7 and 8% for a 30-year loan. That's the highest in 2 decades. But home prices, they're still elevated because the supply isn't really moving in most markets. Maybe some like Florida. Nobody wants to sell a house with a 3% mortgage to take on an 8% mortgage. You can't even downsize at that rate. So instead of crashing, the housing market is choking. New buyers are priced out, existing owners are stuck, and builders are hesitant to flood the market while financing costs stay elevated. It's not a crash, it's something worse, a standoff. Now, you might think Congress would step in to kind of address some of this, but Washington's stuck in a fiscal straitjacket. Any serious attempt to reduce the deficit means cutting entitlements, raising taxes, or slashing something like military spending, which are all political suicide. And that means gridlock, it's not the exception. It's the plan. Every year we just kick the can a little bit further down the road, hoping that GDP growth or inflation will just magically solve all of our problems. But hope's not a fiscal strategy. The final actor in this play is the Federal Reserve. And right now, the Fed's backed into a corner. If they keep rates high to fight inflation, they risk detonating the debt bomb. If they cut rates to ease that pressure, inflation could come roaring back. And there's no clean exit. There's no way out of it. Only trade-offs. The bond market, it's not just sending a signal. It's issuing a warning. And when that foundation starts to crack, everything built on top of it, retirement systems, housing, even the dollar, they're all at risk. Foreign buyers are slowing down. China is divesting. Japan is cautious. Pensions and insurance companies are constrained by rating mandates. The Federal Reserve is no longer in buying mode. So if the Treasury keeps issuing bonds and they're rolling over their debt and the demand's not there, what happens? Yields rise, prices fall, and the spiral tightens. And this is where demographics pour gasoline on the fire. The Social Security Fund peaked in 2017 at just over $3 trillion. It's now declining fast and expected to hit zero in under a decade. Why? Because the biggest generation in American history, the baby boomers, they're all retiring en masse. And that means the government is cashing in on those bonds to pay off benefits. And when those bonds are sold into a weak market, it drains demand and it pushes rates even higher. And here's the trap. The government can't stop paying Social Security. That's a legal obligation. So, what are the options? Raise taxes, cut spending, or borrow more? And if you think Washington will choose the first two, you're being way too generous and probably a bit naive. So, the borrowing continues, the cycle continues. Since the 1960s, the US has only reduced the total debt, government plus private, 5 times. Twice in the Great Depression, once during the 2008 financial crisis, and that's it. Every other year, debt has gone up. Because if debt didn't expand, the system contracts. And nobody, not the markets, not politicians, not the voters, nobody wants that. Back in 2008, the total debt was around $50 trillion and the monetary base was about $1 trillion, a 50 to 1 leverage ratio. Today, the number's closer to $100 trillion in debt and a Fed balance sheet still bloated from the pandemic era. We're too deep in the hole to climb out clean, which is why Lynn Alden and others call this a structurally leveraged situation, self-reinforcing cycle. If we stop borrowing, the system breaks. If we keep borrowing, yields rise, and it still breaks. That's the trap. It's a catch-22. So has this ever happened before? Yes. After World War II, the US government debt to GDP ratio was over 120%. But we got out of it by holding interest rates low and letting inflation run hot, a strategy called fiscal repression. Over decades, inflation quietly eroded the real value of that debt. But back then, we had good demographics, a rising middle class, and tons of productivity growth. Today, we have the opposite. That means the tools we used last time, they're not going to work this time. Interest rates, they're already elevated. Inflation, it's already high. And the public has very little tolerance left for more money printing. J-Powell. But make no mistake, this isn't a political issue. It's just a math issue. So what can you do about it? Don't put all your eggs in one basket. Own some total market index funds, some hard assets like real estate, especially if they're income producing properties, even something like gold, and maybe a little bit of crypto. And spread out your risk into several different sectors. So if tech stocks crash, gold's probably going to go up and you'll probably make out okay. But don't put all your eggs in one basket. If the US bond market, the core of the global financial system, starts to truly crack, it's not just going to take down portfolios. It'll threaten the entire economic structure that we take for granted. And the early warning signs, they're already here. Downgrades, demographic pressure, foreign divestment, and the return of inflation. The next chapter is not written yet, but the page is already turning. Thank you so much for watching. If you don't want the economic system to collapse, then hit that like button, subscribe to my YouTube channel, and leave a comment down below telling me what you would do to fix this problem. Are we going to get out of it, or are we just doomed? Thank you so much for watching, and I'll see you next time.